Hello and welcome to another episode of Bidishanomics. I am Sabika Syed and with us Dr. Bidisha Bhattacharya, our consulting editor for economics, who takes your questions, dear members, on economy, India's position, everything that's been happening recently and everything you send our way. The first question is by Sanjay Tiwari. He's asking, with the current price of crude, natural gas, fertilizers, pressure on remittances and RBI burning forex to rein in the dollar, do you foresee a serious BOP crisis unfolding in front of us? Many economists who found little fault in the economic policies of the current government few years back are now ringing alarm bells. Where do we stand on the BOP as of now and in the foreseeable future?
So Sanjay, thank you for the question because it might sound technical on the surface, but this is an issue that affects all of us,
Right.
from the cooking gas to the fertilizers that farmers use to what will be sort of the exchange rate in general if you're traveling abroad. Everything boils down to this one particular discussion, which is India's balance of payments. So before we get into whether we can foresee a balance of payments crisis or not, firstly, what is exactly balance of payments? It's basically a book of accounts that records all the transactions India makes with the rest of the world. The BOP now has two main parts. There are two specific categories. One part is called the current account and the other part is called the capital account.
Okay.
Now, current account is the section that records all transactions that are happening in trade in goods and services and also remittances of Indian citizens who are working abroad. Then comes capital account.
Okay.
Capital account records all the money that is flowing into India through foreign investment, through loans, through also foreign direct investment, to be specific, foreign portfolio investment as well. Now, what happens usually is that when the money that is coming in is greater than the money that is going out, we usually have a current account surplus or a balance of payment surplus in general. And when the money that is flowing out is higher than the money coming in, we have a deficit situation. Now, every time there is a current account deficit, the capital account steps into the picture to make up for the entire situation. But sometimes what happens is, if the capital account also fails, if foreign investment flow for any reason, XYZ reason, is not being able to make up for this deficit, that is exactly when the RBI steps into the picture.
Okay.
And they sell dollars or they spend down out of their foreign exchange reserves that we have, which is exactly what we are watching unfold today. So now, coming to where do we stand in this entire picture right now? I'll go quarter by quarter from the data perspective. In the January to March quarter in 2025, the current account surplus, India had a current account surplus of 13.5 billion. But that is not something that we usually need to celebrate, because usually between the Jan to March quarter of any year, we see a current account surplus because the IT services billing is high, remittances are strong. The import bill is also, usually imports are on the lower side because it is seasonal. Then comes the April to September quarter. That is where we noticed in 2025, I'm talking about, that we moved from a surplus to a deficit of $2.4 billion. It started worsening after the second quarter. In the third quarter, we see that the deficit increases to $12.3 billion. And in the October-December quarter, we see the deficit widening even further to $13.2 billion. The January to March 2026 quarter data has not been released by RBI yet, but again, as you know, usually what is repeated in every year, we can expect certain amount of surplus or the deficit slowing down,
Right.
because of the seasonal bit, the remittances being strong in the Jan to March quarter usually. Now, coming to the full year, there has been an expectation, or reports in general, that the total in 2026, the current account deficit or the balance of payments in general can land between 27 to $30 billion. which is 1 to 1.3% of GDP.
Right.
Now, why I am speaking about this data point is because, as a rule of thumb, economists usually say, historically, this has been in different reports, economists usually say that if the current account deficit as a percentage of GDP exceeds 2.5%, then there's something to worry about.
Okay.
Not before that. So right now we are standing at, or we can expect to be at, between 1 to 1.3% of GDP. Here comes, but then why are we worrying about this? Is there any real stress that is building? There are three pressure points that is making everybody worry at this point in time, because they are all happening simultaneously, and simultaneously they are creating a very uncomfortable picture. The pressure point one is that the import bill is exploding.
Okay.
In the financial year of 2025-26, the oil import bill, just the crude oil import bill, was approximately $135 billion. If I add fertilizer, gold, vegetable oils into the picture, the bill increases to $241 billion. Now, what happens is, usually in April 2026, we noticed that the oil prices surged globally. The oil prices surged to $121 per barrel. And this was the highest since the Ukraine, war strike in 2022. So here, the worrying bit is, or the calculation bit is, that every time, because we are such an oil dependent economy or an import dependent economy, every time oil price increases by $10 per barrel in the world as well, our annual import bill increases by 12 to $15 billion.
Okay.
So you do the math. The way oil prices are surging at this point, this is the first pressure point. Second pressure point is, which is something that extensively nobody is discussing as such, but in the print we have, in the latest piece that I've written, is that the capital account is quietly fading away in some way or the other. Now, the capital account, in the capital account specifically, there are two parameters that are looked at, or two kinds of investments that are looked at. One is called foreign direct investment, and the other is called foreign portfolio investment. I have categorized or called foreign direct investment as patient money and foreign portfolio investment as hot money. If possible, we'll put the chart. There's a graph that clearly shows what's exactly happening. Now, over the last few years, India was a destination for foreign direct investment. And why I call it the patient money is because foreign direct investment is kind of a stable long-term money that is used for building hospitals, educational institutions, and also in general for running factories, for employing more people in different sectors. Foreign portfolio investment is like, just investing overnight, money flowing in, flowing out of, spot and forward markets overnight. So this is not really, it's a volatile kind of investment, and that is something that can lead to a lot of outflows, which is something that we've been experiencing lately as well. Now, coming to the data point, for the last few years, India has been a very strong destination for foreign direct investment. We used to attract foreign direct investment of up to $40 billion as well. The net foreign direct investment is what I'm talking about. Today, that number is very close to zero. And now coming to foreign portfolio investment as well. I mean, if that could make up for the capital account at this point in time, there has been a huge outflow of FPIs from $3.7 billion. It has fallen to a negative of $16.7 billion. So, which is why capital account is not being able to come to the rescue of this current account deficit at this point. And that is the exact reason why RBI is having to step in and deplete the foreign exchange reserves and spending. There has been a 30 to 40 billion drawdown from February in just 3 months, from February to May, from $728 billion to 690 approximately. We are standing at 690 today. That brings us to pressure point 3, which is RBI's depleting foreign exchange reserves. So this is something which, I mean, the RBI has no other option but to defend the rupee, the depreciating rupee. It has to spend dollars using the foreign exchange reserves. And as I just mentioned, there has been a drawdown, and now we are standing at $690 billion, which sounds like a big number. It is as well, but it is something that can work as an import cover of, let's say, 10 to 11 months of import
Okay.
cover. After that, it will get a little risky.
Hmm.
So here, I would also like to mention, before I go to all the data that I've given you, and if at all we are moving into a crisis, this kind of makes me recall a concept in economics, which is the twin deficit problem. Now, what happens in twin deficit problem is there are stages or issues or stages or phases in it that an economy goes through when it is undergoing a current account deficit as well as a fiscal deficit. So this gets a very risky situation because one starts feeding on the other. What happens is government also starts borrowing heavily for domestic consumption or domestic investment and expenditure as well. And as a result, it leads to crowding out of private investment. That leads to lowering of aggregate demand. That leads to putting pressure on the trade balance as well, which causes inflation. So it's kind of a vicious cycle, and a twin deficit crisis is not what I would say that India is going through at this point, but the stress levels are quite visible at this point in time. Now, coming to the question that Sanjay asked, which is this a BOP crisis?
Right.
My honest answer would be not yet, but the signs do show. So here, and why am I saying not yet? Let's go, to put this in perspective, let's say back in 1991, when we had a genuine BOP crisis, that was the time when RBI was left with, let's say, 2 weeks worth of import cover.
Okay.
We couldn't even pay the basic bills. We had to pledge gold to the Bank of England. That was the situation. Even going back to let's say 2013 taper tantrum, that was the time when current account deficit had ballooned to 5% of GDP. That was something to worry about. But now, given the situation that we are in, I don't think we can expect a BOP crisis to take place. What right now India should do, I would say, that not just firefighting but something structural. By firefighting and by not firefighting, I would say, or what do I mean by firefighting, is just that increasing import duties. In the earlier episodes we've spoken about increasing gold import duties, or just taking care of the import bill. Instead, focusing more on structural, which is where the export needs to be looked into, manufacturing, or sort of creating the environment for the right kind of investments domestically as well. There's a piece on how to encourage or incentivize the middle class to enter into the bond markets and invest, that I've written. So this would be the area that India can right now focus on, but a crisis is not in the offing at this point.
Right. Now, Bidisha, petrol prices have been going up. Narendra Arya has quite an interesting question on this. He's asking, if petrol is brought under the GST system, how will things be for the Indian economy, consumer and state governments, considering that GST also varies state to state?
Correct. So this is one of the most debated questions in the government since the time GST was introduced back in 2017. And the reason is, every time, of course, I mean, why is petrol not in the picture? Just to give you a brief idea as to what had exactly happened in July 2017 and how did those reforms come about, and why, as a result, why is petrol, crude oil, aviation fuel for that matter, why are they not coming under GST? So first, let's understand what is the actual situation right now. When I go to a petrol pump to fill the tank, usually every consumer, every individual at this point in time, they are not just paying the base price of petrol, they are also paying, first, the tax that they pay is something that is levied by the central government, which is called the excise duty. Now, that is uniform across states, that does not change. Then comes another tax which varies from state to state, which is called the value added tax.
Yeah.
It varies, let's say, for instance, in Odisha levies 32% VAT. Then there is Uttar Pradesh that levies 26.8% VAT. There's a big difference between, sometimes there are certain states that charge much lower tax, there are certain states that charge much higher tax. Now, the result of all of this is that approximately 54% of the money that you pay every time you go to a petrol pump is actually the tax that you're paying.
Okay.
And the rest, that is more than half for that matter, and the rest of the money is the base price. So here the situation that arises is, now, why is petrol outside GST in the first place? Was this not stated in the law? This was very clearly stated in the law when GST was introduced in July 2017, that crude oil, petrol, aviation fuel, these things would be incorporated under GST over time. And this was mentioned in the law, but this was left to the GST Council to decide. Now, the GST Council comprises of the center and the states, and everybody has to come in a consensus to decide to bring in these under GST, and the states did not agree to it. I'll tell you why. Because VAT and sales tax account for 90% of government revenue that comes from petroleum products. VAT is kind of, or this tax specifically is an area where the states have an upper hand. Whenever there is political pressure, they can cut down the tax. If they have to increase expenditure for building certain infrastructure, they can increase that VAT. That flexibility goes away if petrol tax comes under GST. So now coming to what, let's imagine a hypothetical situation, as Narendra mentioned, that what would happen if petrol would come under GST. There would be 3 impact points in my opinion. The first impact point would be you, consumer.
Right.
So here what would happen, the good news part is the maximum GST slab rate is 28%. Even if this comes under the maximum GST slab rate, we would still be paying much less compared to what we are paying right now, if this comes under GST. Now, the best part is, under the GST component or the GST slab in general, what would happen is, of course, my consumption would increase. Of course, my cost of living would go down. But the best part about this particular fact is, there's a lot of individuals do this. They cross certain states to be able to sort of fill their tanks at lower price. So that is something that would stop. And at the same time, usually, if this can be incorporated, or if the petrol can come under the GST slab, then in that case the transportation costs would reduce.
Okay.
The sort of food, grocery, the minute transportation costs fall, the food, grocery or food inflation can be contained to a great extent. The cost of living would excellently, this is an excellent way to reduce the cost of living for people in general, and in today's day and age when inflation is rising, and that can actually boost aggregate demand over time. Next, coming to the second impact, which I think doesn't get discussed much but is extremely imperative at this point in time, which is how would businesses get affected, or logistics to be specific. Now, there's something called the input tax credit that businesses can ask for. Under the GST, specifically, if businesses are paying tax to buy something that is used in their operations, it can be services, it can be raw materials, it can be oil, anything for that matter, then they can actually subtract that from the tax that they would be paying to the government. That is nothing but input tax credit. In this particular situation, let's say a trucking company or a courier service for that matter, they cannot, it's a tax or a cost. They considered the fuel price as a cost instead of a tax, because they cannot file for the input tax credit, as that is outside of GST. Now, the biggest issue with that is that contributes to our increased logistics costs. In a couple of episodes earlier, we had discussed how, from a non-trade barrier point of view, India is not in a competitive space, or India is not being competitive even from the logistical point of view, because our logistics costs are very high compared to China, let's say, for instance, or our neighbors in general, Vietnam even for that matter. That would actually contribute to a great extent if petrol tax came under GST slab to reduce the logistics costs. Now comes impact number 3. This is where the state governments enter into the picture. They would not be, this is the hardest part of the entire story, they would not be in favor of this entire picture, because this helps them with certain expenditure. They can increase, as I earlier stated, that they can increase the VAT whenever they want to, and 90% of their revenue comes from the sales tax and VAT on petroleum products. So now, and this also is very challenging, because that puts a question. Center tomorrow can't just decide. In 2024, the finance minister had actually said that they have plans. They want to bring the fuel prices under GST, but it's the states that are not coming into a consensus regarding this. So The only reason being that in India's constitution as well, or the entire discussion around fiscal federalism, where states are also given certain revenue rights, which might be put into question if this kind of flexibility is taken away from the states.
Right.
So this is the most difficult area, I would say. Now, what is possible, or is this ever possible? I think this is possible slowly and gradually, because this seems very rational, this seems doable. What is possible, in my opinion, is a dual rate structure.
Okay.
So now a base rate GST, which is 28%. Now above that, a cess can be charged, which can be shared and calibrated between the center and the states.
Okay.
This would be an interesting way to go forward with.
Right. Now, Bidisha, the next question is by Anubhav Saxena. He is asking, for the Indian rupee to stabilize, what are the actions that the Indian government needs to take, and what are the hurdles that they might have to face?
This is one of the most important economic discussions at this point in time, because I mean, last year, even when rupee had gone up to 85 or 88, we were all very concerned as to what is exactly happening. And at this point in time, even 88 seemed quite reasonable, because it was helping us attract exports to an extent, because a little bit of depreciation is good for any emerging economy, for that matter. But right now, the situation seems a little dire. And now, firstly, it's important to understand where we are and why are we here, and what does the government actually plan on doing at this point in time. Firstly, the state of the rupee. It's important to understand that in 2025, as I mentioned, for a couple of years, the rupee has been depreciating, and depreciating at a very fast rate at this point in time. So from 85 to 95, and now coming to and this is very important, that the chief economic advisor very recently had also stated that this rupee depreciation is primarily happening because of external factors, because of the geopolitical disruptions, and as a result, the trade imbalance, and capital outflows, for that matter. But I feel like the entire blame cannot be put at this point in time to external factors. There are certain domestic changes that need to be done immediately. Okay. So now, and this is important, the chief economic advisor has recently stated that the rupee depreciation is primarily happening because of external factors, as a result of which many other emerging economies as well, South Africa, Brazil, even for that matter, all of their currencies have not been performing very well. But it's important to understand that India's currency right now has been emerging, and this is RBI data, proper data, where, and even economic survey has also shown this, that we have been performing really not at all good compared to our regional peers. Right. So which is something to worry about. Now, why is the rupee weak? There are three core problems for it. Number one is trade deficit and oil dependence. As I said, with crude oil standing between $111 to $121 per barrel, and us being, 88% dependence, import dependence on crude oil, obviously oil buyers, or any factory or any company for that matter, that who are importing oil, they have to constantly go to the foreign exchange market, and they are buying dollars, because they have to pay in dollars to purchase that oil, and that import bill is increasing. At the same time, when import bill is increasing, the trade deficit is also widening, because we haven't really kept up with the pace, or the let's say the foreseeable future that we had for exports. Okay. We have not been strengthening, and it takes time as well. Manufacturing exports, to strengthen manufacturing exports, it takes time. Now this is putting a downward pressure on the rupee even further. Coming to problem 2, which is the collapse of capital inflows. As I earlier stated, foreign direct investment, or net foreign direct investment rather, I would mention net foreign direct investment here, because foreign FDI inflow is happening, but outflow is much higher. As a result, the net FDI is very low, so that stable, strong money that will stay for a while with the economy is not there. And at the same time, there's huge amount of FPI outflows that have taken place lately. Even if you look at the data, it has, as I mentioned earlier, it has fallen from 3.7 billion, a positive 3.7 billion, to a minus 16.7 billion, for that matter. So here, this is kind of creating an FDI paradox rather, that economists are calling. So in this particular situation, we come to what can the government do, or what does the government need to do. We can go action by action. The first, I would say, to fix the trade deficit structurally, not sort of, just from a superficial point of view.
Okay.
So this is where, the immediate instinct for any government under currency pressure is to start, selling dollars and defending the rupee, basically depleting the foreign exchange reserves for that matter. So the real solution here, and India needs to understand this. I've mentioned this in my in the latest piece as well, that we need to boost our merchandise exports. IT services are strong, fine, but merchandise exports have been still stuck at 2% since the 1990s period, and even before that. So this is something that needs to be boosted, and this is a very lucrative time to do that. We have electronics, we have pharmaceuticals, auto components, specialized chemicals even for that matter. And with the India-US trade deal now, that has dropped the reciprocal tariffs from 50% to 18%, this is a very lucrative time for us to figure out the areas where we can boost production, increase the midstream capability, because that is an area where we are weak at, and boost the merchandise exports. That will automatically take care of the macroeconomic situation in the country as well. It will take care of the unemployment situation as well, because manufacturing boosts employment and like no other sector for that matter. Then coming to the second action, which is attracting stable long-term FDI, not just hot money. So now here comes sort of, like a direct investment which builds factories, which builds hospitals and, social sector infrastructure in general. Now to attract genuine FDI, it's important right now to attract genuine FDI. What are the ways to do so? First, reducing non-trade barriers. Now this has been a biggest issue for us, getting faster approvals from whenever these investors come into the picture. Faster approvals have to be done. There has to be strong industrial parks in place, because that boosts investor confidence. If it takes you 6 months to a year to just get a particular tag or get the documentation or the contract in place, then of course that doesn't make or makes this an unattractive destination for foreign direct investment in general. So that needs to be boosted. Now then comes the action 3, which is using NRI bonds and diaspora. Now, this is something that was done in 1991, in 1998, in 2013 as well. So we have a 35 million strong Indian diaspora, which is the strongest, in fact, and wealthiest. So there, building sort of an NRI bonds, or in 2013 this was done as well. The RBI had raised a good amount of money, or asking NRIs to deposit, in return of a good interest. So that's something that can be done at this point in time. Then coming to action 4, which is the most difficult, which is accelerating rupee internationalization, which is trying to at least do certain trade settlements with the neighboring countries, or the African countries, or even Russia for that matter, in rupees. This is something that the RBI has already begun to do, but it is of course a difficult job to do. I mean, settling in rupees, because that will automatically reduce your demand for dollars. You will not have to buy so much of dollars. Being an import dependent nation, that gets a little tricky, and that will automatically take care of your exchange rate, of your rupee depreciation. So this is something that can be done. And what are the hurdles? The biggest hurdle is India's manufacturing sector, which has not been able to keep up pace. I am not bringing the example of China here. I'll bring the example of Vietnam. Cost competitiveness. If the cost is not low, where I mentioned in the previous answer itself regarding logistics, it boils down to something as simple as logistics cost. If that can be taken care of, automatically we will start becoming competitive with a Vietnam or a Bangladesh. There has to be a level playing field. And why am I mentioning Bangladesh here? I'm talking about manufacturing, I'm talking about textiles, I'm talking about these footwear, these particular areas where if we need to appear as an attractive destination in terms of manufacturing, these non-trade barriers needs to reduce. So that would be sort of, specifically my response. But also I feel that right now, at least from a textbook economics point of view, we are going through, as a country, we are going through a J curve effect.
Okay.
A J curve effect is basically, something that we studied in international trade or international economics, is where a currency depreciates to an extent where initially in the short term, the economy doesn't do well until it starts doing very well. So now this pain point, how the government is going to deal with this pain point, will completely decide the future. Where we go from here, where the trajectory is decided. So yeah.
Now, Bidisha, lots has been happening through the Strait of Hormuz, and ever since this conflict started, one area that has come into focus was fertilizers. And you've done a piece on this. We'll link it. Ranjit Pal is asking, how does Government of India calculate subsidies on farm fertilizers and give out the subsidies? An additional question is, will a good increase in fertilizer price reduce random use of urea-like fertilizers by farmers?
Very interesting question. As you very rightly stated, Sabika, fertilizer has been a pain point for us, apart from oil as well. So now, firstly, it's important to understand, why does this subsidy exist in the first place? India feeds 1.4 billion people, and there's a huge sector where crops will fail, because if subsidies, or if something like fertilizers, which boosts crop production or crop yields to a great extent, if that's left to the global markets, then certain kinds of volatilities, or issues like disruptions in the Strait of Hormuz, any kind of geopolitical shock would lead to huge price increases, and farmers will not be able to afford that, which is why the subsidy exists in the first place. Now, how does the structure function? There are two parallel systems that are operating simultaneously, one under the fertilizer story, or the fertilizer picture. One is for urea, the other is for all the other fertilizers. This is the story. So the first is urea. This is a very interesting story, which is a price controlled fertilizer. Now, urea in general, what does urea do? It basically enhances crop yields for you. Now, here comes an interesting story. Since 2018, the price that a farmer has to pay for, let's say, 45 kg of urea was decided to be around between 242, some people say it's 266, but approximately 242 per 45 kg of urea. Now, this was decided back in 2018, March 2018, 8 years ago, and it has not changed ever since. Now comes the number which might make your jaw drop. The cost of producing urea is rupees 2,200 rupees. So if a farmer is paying 242 rupees, then the difference is paid by the taxpayer or the government in the form of subsidy, which ranges between 1,950 to 2,000 rupees approximately. Now, what happens is, which is covering 90% of the actual cost. The rest, of course, adds up to an enormous number. India's total, I'll give you this specific data point, India's total fertilizer subsidy is projected to be 1.9 lakh crore in 2025-26, of which 1.3 lakh crore is just for urea. And the total agriculture budget in India is 1.5 lakh crore. So this is the number that is here. So now how does the money flow, and why does a farmer spend so much urea? It's simple price elasticity of demand that is happening here. If something is so cheap and so easily available, you will misuse it. And that's exactly what's happening right now. More than required urea is being utilized, and that's showing up on our soil health as well, something that I'll get to a little later before I speak about the second parallel system, which is the nutrient based scheme, or nutrient based subsidy, NBS, that is spoken about, which is where other fertilizers like phosphorus, DAP, MOP, potash, sulfur, all of these come into the picture. This is not calculated per bag, but per kg of nutrient that the farmer requires. This is kind of a proper system that is the
Standardized.
standard system that is in place. Now, and that kind of changes from Kharif to Rabi season. It's
Okay.
different. For Kharif season specifically, the government has allocated around 41,000 crore, for this NBS scheme in
Okay.
general. Now coming to just for phosphorus and potassium fertilizers. Now, how does the subsidy actually reach? This is also an important area that needs to be looked into, which is the direct benefit transfer scheme, where the farmer or the dealer in general goes and through Aadhaar or the Kisan credit card specifically, there's a record that is made, and only then does the government release the subsidy. So it's not just that, there's no, to make sure. Now this has helped greatly, the direct benefit transfer. Earlier as well we had discussed about this. This has helped greatly to make sure that no leakage is taking place, there are no black markets for it. Urea usually often gets utilized or diverted for industrial use. That is where the neem coated urea came into the picture, because if it's bitter, and neem coated urea is also unsuitable for industrial use. So which is why these are the ways that the government could stop the leakages, and the direct transfer used to happen to the farmer. Now coming to the, will higher fertilizer prices reduce overuse? Yes, higher prices reduce overuse, but it depends on how you do it. Now, firstly, for a good soil health, as per every research report across countries that has been done, the NPK ratio stands to be at 4:2:1.
Okay.
That is sort of, for 4 parts of nitrogen, you use 2 parts of phosphorus and 1 part of potash. That ratio started eroding from 2009 to 10 onwards. It started with 4:3.2:1 back in 2009 2010, and now we stand at 10.9:4.1:1. That means 11 parts of nitrogen is being used, which is where urea comes into the picture. 11 parts of nitrogen is being used for 4 parts of phosphorus, and potash stays as it is. Why? Because we are completely import dependent when it comes to potash. We do not produce anything when it comes to potash in general. So now, especially, and this is completely coming from when you're just paying 242 rupees, this is supposed to be happening. This is expected. Now come to the consequence. This overuse of nitrogen, what it is leading to is it is leading to depletion of certain micronutrients, which is very clearly visible. There was a soil health card scheme as well in 2015 that was rolled out by the government, but that was kind of not really implemented well in districts. So here comes an important picture. Iron and zinc are getting depleted, and visibly the wheat fields in the Indo-Gangetic plains, their produce has plateaued or even stagnated for that matter. Back in 1991, the ratio, let's say the fertilizer to grain ratio was 1:10.
Okay.
Which meant that if you use 1 kilogram of fertilizer, you could generate 10 times more of the produce or the agricultural grain. Now it is reduced to 1:2.1.
Okay.
So that is the fall. And when this happens, and you have to feed not only 1.4 billion people, an emerging economy where the population is multiplying over time, imagine the dire situation, the difficult situation that the government or the agricultural sector might be facing. So it's high time that we realize this, and this is not only realize this but also address this from a political economic point of view, because political economy comes into the picture. We saw in 2020 2021 what the farmer protests had done, and this is a very political economic area where even political parties are very scared that they would lose vote share even if they increased the urea price, let's say, by 100 rupees. But there was a proposal by this economic survey in 2025-26 which I really liked, which was like, do a direct transfer, sort of decoupling the subsidy from the price of urea. Where you do a direct transfer to the farmer of whatever cash transfer that you're doing, and let the urea prices stay as it is. Then what will happen, when they'll see the actual price of urea, they'll actually try to educate themselves as to what would be the optimal balance that would also not seem expensive to the farmer, but at the same time the soil health would be rightly maintained as well. So this can be something interesting that the government needs to look into. This was proposed by the economics in the economics survey. This is in the economic survey
Okay.
2025-26. So yeah, that would be my response.
Bidisha, that brings us to the end of our episode. Thank you so much for taking questions from our members. Bidisha has mentioned quite a few of her pieces. She's been covering the impact of the geopolitical shocks and how India's agriculture, India's economy, the rupee has been dealing with it, reacting to it. I'll link those pieces in the description. Thank you so much for watching. We'll be back next week with another episode of Bidishanomics.